All right. We are live. Let them in.
All right. So I'm going to let everybody in. Oh, you're already letting them in. Good.
Yep.
Good evening. Good evening, everyone. Thanks for joining us in this happy Monday for Creative Deal Maker.
Yep.
Doing a little, we're going to do some deal or no deals tonight and kind of go over what's been going on talk a little bit about what's going on in the market, especially we might chat a little bit about what's going on in our markets and the opportunities that are coming up with some of the wholesalers and that are out there on how we acquire a lot of our deals. So give you guys a couple. Let's give you a couple seconds here to get everybody in on the call here. Let's see here. I'm going to get you do a little housekeeping. Real quick. I think we're gonna do.
Yeah, so let's do this. We'll do the Q&A first.
Yep.
Okay, we have that came into Facebook, and then if anybody has a deal or no deal they want us to look at, raise your hand so we know that you want to go through one, and make sure you have everything ready to share your screen so we're not fumbling back and forth. So make sure you have, where it is, because we'll give you screen share. You'll run the model, and then we will walk you through it, make ideas or make suggestions, and I can give you ideas and stuff like that. But so if you have one that you want to do that, let me know, and we'll get started here in just a second. Give me 1 second here.
Yep, we're just letting everyone hop on here. Also, if it's your first time listening to getting on some of these Zooms, just put yes in the chat. We'd like to know who the new people in the group are who haven't who found us either through Facebook or some of the other ways that you find us. That would be great. It's good to see some new people on here. I guess Alice and Vonda, and I'm not going to even try to pronounce that his name. I don't want to butcher it. So this is great, getting new people on the call. This is really important time in our market for real estate professionals and people that really haven't don't understand kind of what we do. So sorry.
I will tell you this, I got them coming out of the woodworks now. People that I haven't talked to in 3 and 4 years are all of a sudden mysteriously calling me now. And why is that? Because now they realize it's not so easy to sell these deals for cash.
Cool. I'll just call you.
There's not that many buyers out there anymore that are retail buyers or hedge fund buyers or secondary or tertiary market buyers.
Right. Hey, so
there's not that many Burt guys out there anymore.
So Nick, real quick. So there's a lot of people that are new on the call tonight. So I just want to give you a brief background about me, and then Nick, you can do it just a little like a 2-minute Reader's Digest version. I've been buying and selling houses in the Phoenix and basically all over the U.S. since 2004, full time. I've been a real estate investor full time, fix and flipping, wholesaling. I've split land. I've done pretty much everything you can think of. And I've always come back to note creation, because once you find a house, and rather than fix and flip and be transactional, we fix and flip and create paper. We create mortgages, and we provide homeownership for people who aren't able to get traditional bank financing, but they are phenomenal borrowers. So that's a little bit about me. I've done probably over 1,000 transactions. Nick will probably say the same thing. Between the two of us, we've done a crap load of deals. We understand what we're doing. We're doing deals every day. We just closed on one today. Actually, I think we closed on a couple today. Actually, that's true.
I don't really worry about that stuff anymore. They just if you do the work,
yeah,
and you follow the process, the deals will it's like just building the pipeline. It's all you're doing is building a big old pipeline, and for deal flow coming in, and also payout, right? Because we generate these notes, and it's like a lottery ticket, right? you generate a second note that you don't have any cash usually invested into, and you get monthly cash flow. And then eventually somebody just sends you a big fat check for the balance when they sell it, or, refinance it, or pay it off. So that's the beauty of this model.
So real quick, Nick, give them just a quick Reader's Digest version. I'll just tell you real quick, there's nobody better at the business that we're talking about that I know of. I met Nick in a mastermind, shoot, I don't know how, at least 10 years ago. And that's why he and I partnered in Creative Dealmaker to teach more people about this business, to partner, do deals, and learn about how to structure being a note creator. So Nick, just do a quick.
Yeah. So
I know I have a lot of people on
the best thing is, the best thing I'll say is this, is that it doesn't matter where you learn how to acquire deals from. It doesn't matter. There's a lot of great educators out there that teach you how to find deals. That's not what we teach you. We do not teach you how to find deals. We teach you how to create cash flow machine by controlling real estate, not owning it. It's a whole different model. So you have to ask your question, am I willing to take risk in lieu of a higher return, or would I rather have a solid return with infinite ROI or no risk? It's a personal question. Okay. I already know the answer for me. I will take the money all day long and have it with no leverage. I am not a fan of leverage. I think we just learned, when COVID hit, screwed things up for a lot of people. When the market changed and the interest rates go up, screws up a lot of models. What doesn't screw up when you own a free and clear note is your ability to get paid, because you're going to get paid as a bank. We talk about how to think, act, and be a bank. Banks always get paid. They just do, because they have the golden handcuffs on the borrower in the form of the property as the collateral. So you may not get paid today, you may not get paid tomorrow. You might take 6 months or even a year to get paid, but you will get paid. It's just not possible not to get paid, because you have the property as collateral. Now, do you want to chase down that path to get it all? Well, maybe you do, maybe you don't. There again, that's another personal opinion. So I want to talk about, there's 4 things that you need to know how to do, okay, that we just don't do for you, okay? Number 1 is you have to be able to find a deal, okay? Whether you're a wholesaler, a fix and flipper, a landlord, realtor, hard money guy, you all have to have, before you can do anything in real estate, you have to have a deal. We don't tell you how to find deals. That's easy. And we can tell you, we don't break it down on how to go negotiate to find a deal. We'll tell you how we do it, but that's not what we teach. That's number 1. Then after you find the deal, you have to analyze the deal, and you have to analyze it relative to being able to exit out with seller financing, not to hold the property, but to create a note and hold the note, not the property. That's what we call control versus owning. That's what banks do. Banks don't own anything. They control everything. Okay. The next thing you have to do is you have to be able to fund the deal, meaning you have to be able to fund it either with hard money, your own cash, private money, seller financing, sub 2, sub 3, whatever. Okay. There's some recommendations and referrals in our resource center that you're more than willing to look at, but how you acquire it is of no significance to what we do. There's better ways to acquire, there's better deals to be made, but it doesn't mean you have to ultimately do one or the other. Then the last thing you have to do is you have to be able to find a seller finance buyer, somebody that needs seller financing that can't go down to the bank and get a loan. And those 4 things are no different than anything else a wholesaler does today, a landlord does today, a fix and flipper does today. They're all the same. They got to do all 4 of those things. It's just a different, maybe a different buy box. It's a different finish out. It's a different buyer on the back end. Once you get to that point, then that's where we come in, where we help manage the transaction to create the notes so you can generate long-term cash flow. And what we do, we teach you how to create a first lien and a second lien, sell the first lien, pay off the debt if you choose to do so, stay in the deal, usually with a free and clear second note. And that's it. It's what we do. You don't have to manage the transaction. You don't have to underwrite the buyer. You don't have to create the servicing. You don't have to escrow the taxes and insurance. You don't have to do any of that stuff. It's all, there's a system and a process for you guys to take advantage of to do it all for you. And the reason why we do this is really simple, because we're note buyers. And I can promise you, I'm not buying any note from anybody on this planet that I don't know how it was created and if it didn't follow our protocol. And the reason why that is because we've been doing this a long time. And I know that the notes that we create and the notes that you can create by following the process are highly desirable premium notes, hands down. It's the name of this game. It's about creating high quality notes that are extremely valuable and desirable. And as a result of that, you're going to be able to basically sell that first lien for anywhere between 8 and 10% more than what the national average is, because that's what we've been trending for the last 800 notes that we've done. So there it is. What did I miss, Eric?
No, you're good. No, it's good. It's just, so we're going to go over.
All of this is great, but I want to say, because I want to take advantage of the time to go into deals, right? Actual live working deals that we can help answer questions for. If you guys, all the stuff that I just talked about, it's all in the digital product, 100% of it. Just go review it. Okay. Go review it. If you bought it, go through the digital product, because it's answers all these questions, talks about how and why we do it. And then we have the who figured out for you. The who can do it for you, but you need to know the how and the why, so you can go structure and got a deal. So if you have a deal, raise your hand, and then let's go make sure you got all your data handy, because I'm not going to sit here and wait for you to pull up your spreadsheet and stuff like that. So if you have one and you're ready to go, post it up there. We're going to do a few Q&As and then we'll go into the deals. But guys, if you don't have the digital product, you really need it to understand what we're talking about, because we're not going to go teach the digital product here. Okay. The digital product is there for you to really get a foundation established on what it is that we do. Okay. It's very inexpensive, at least it is for right now.
Nick, and real quick, I'm going to give you guys an example. We have, because you probably found us. Somehow you found us because you are in real estate right now. You either have a profile of, you're either a real estate agent, a fix and flip, or a wholesaler, and you're tired of transactional, or at least want to add the cash flowing model into your business, which is what we do. And so that's why you're here. And so this is Nick and I do these calls every week. We've kind of switched it up to just do some night ones recently, just because people are busy on Mondays, and we have the replay. But the way our Facebook group is kind of where everything is housed is when we want to do deals live, so we can answer all the questions to the masses, to you guys. So that's why we really
to be able to do that efficiently, and everybody to benefit from it, they have to understand the foundation of what we do.
Yeah,
you just have to, because if you don't understand how the amortization tables work, and how the cash now, the cash flow, and the cash later works, and all the deals and all the documentation, and why it's all there and why it's all required, you won't have a full understanding of this process. And if you don't have a full understanding of the process, you'll make mistakes, and it'll cost you a ton of money by doing it either incorrectly, or just making a bad.
Nick, I will. We'll go through Q&As now. I know we kind of ramble a little bit, but I want to give you one. So I talked I want to say he's one of my mentors. He's been in the note business for 50 years. I talked to him today about another deal that I was working on, and he's just retiring. I think he's retiring. He doesn't really want to retire. I think because he's 76 years old and his wife's 80, and they're just getting a little bit older. And I asked him, I said, how many people, well, he's been doing a ton of loans. I mean, he doesn't even try, and he does $50 million a year in seller finance type paper. That's his business. Okay. And so I said, is there always going to be a borrower out there in this world that's going to need financing that traditional banking isn't going to be? And he goes, Eric, it's just going to get better and better and better as the rates change and things go like this. So I always try to put myself, and Nick and I try to put ourselves around the best. And so I told him, I go, why in the hell are you retiring, man? Like I will pay you to just not retire so you can be around me, so we can keep growing together. So we're working on it, but it was kind of a neat call that I had this morning, and I wanted to share that with. I mean, we are in a great time in the market. So anyway, all right, Nick, why don't we go through some Q&As real quick, and then we'll start doing a model.
And if anybody's got a deal they want, make sure you raise your hand. I can't see everybody, and so when you raise your hand, You guys go to the front of the queue so we can see it. And I know Douglas is on the call. I want to bring Douglas on if Douglas has time to talk, because Douglas and I were at a property earlier today, and I want to have him talk a little bit about some of the interesting things that we came across when we were there, besides all the fleas that we had on us. But that's another story. So, all right,
Are you itchy right now? I'm itchy.
I'm not itchy. They were all on Douglas and Spencer. They were not on me. Luckily they found a can of bug spray in the front yard, amongst other
It
things.
was actually in my car.
Oh, you had it in your car. I thought it was one of the few things that the seller left us. All right, good to know. So, well, since we got Douglas on right now, let's just figure. So Douglas, do you have a camera by chance? Oh, there he is.
Yeah.
Good to see you, man.
I'll
So
spotlight you.
Douglas is he's actually in Texas now. He was in New York, New Jersey area, and he came down here specifically to do deals in Texas, right? Is that pretty accurate, Douglas?
Yeah, because I know this is the state for owner finance. You can't do that in New York, New Jersey, because I've seen people in foreclosure for 6-7 years, so it doesn't work.
Yeah, but the great thing about it is that people can virtually do this from anywhere, right? I mean, hey, and you got boots on the ground now for Douglas. If you need help doing a deal in Texas.
Oh yeah, I'm
Douglas will
willing.
help you. Douglas is a machine. Doug, when you used to do stuff in New York, how many properties did you used to go? Tell us a little bit about what you used to do when you were in New York. It's pretty interesting.
Probably wouldn't even believe me. I was doing the foreclosure list for a couple of years, and the most property I've seen in one day was 50 properties. But my average was 35 to 40 a day, like sun up, sun down. And basically I would just run through the list and see what properties were good. And, I would get inside, and we had bank keys. So I would get inside most of the properties and be able to assess, more or less what the estimate of renovations were, so we could bid on them at auction.
So I'm going to ask you a couple of questions. So you looked at this house a couple of weeks ago. Yeah, we're going to talk about right now. It's in Garland, right? And then you went and saw it again today. When you saw it the first time, the people were living in the house. This house is pretty. Would you call it a hoarder house, or were they just messy people?
It was a bit of a hoarder house. It was
a little bit of a hoarder house.
Yeah, it was really dirty, and I felt kind of bad because it was like a safety a violation in a sense for the kids that live there. It was the kids living.
Smell, it had a really nasty odor to it.
Rodents, so.
Yeah, so now today you went back, they cleaned up some of the stuff. It wasn't 100% done, right?
It was probably, if I had to put a percentage on it, 60% better.
60% better, which is not great at the end of the day.
No, yeah.
What was your first, so relative to the stuff that you've done in the past, and we'll talk about what we're going to do with this here in a second. What was your first impression of this house? Did you think this was a good house? Did you think this was a horrible house? Did you think it was, what was your impression on it when you first went in?
Well, from my experiences, I thought it was a pretty good house because, I knew I just needed to clean out. The bones were good. It was, it's a brick house. It didn't need any major repairs except for some cosmetic, updating. And I knew, I know the model you guys use as far as selling as is.
So, but somebody that was a fix and flipper, for example, they're probably gutting that thing damn near to the studs. Would you agree?
Yeah, they're probably doing a little extensive work, more than needed to.
Yeah, there's no question about it. I mean, the walls are pink, kitchen doesn't have, stuff. So we're just gonna come in there, we're gonna clean up the property. We'll clean it up and we'll start there first, and we'll get it cleaned up, and we'll price it accordingly. It'll be below market value relative to what it would cost after repairs, and we'll start there. And if we have to do some work after that, we'll see where it goes, and we'll keep the group updated. But at the end of the day, I'm telling you right now, we can show the pictures. I don't have them with me right now, the before and the after pictures. And that I just know, because I've done this literally hundreds and hundreds of times, that I believe that I will probably have a contract on that property by the end of the weekend if they get the house cleaned out by Thursday or Friday. That's my opinion of that. And this house needs
the reason you're going to have a contract is because the neighbor's going to clean it out, and then he's going to bring his friends to buy your property.
Yeah, the neighbor showed up and said, hey, what are you doing with the house? I said, I'm gonna sell it. You know, do you have anybody that might be interested in that can't get a bank loan? What do you say, Douglas, when I asked him that question?
Oh, he knew a ton of people. Yeah, he knew a ton of people already. You know, he can probably get everybody he needs in that place to fix
Yeah,
it.
100%.
He owns, and that guy, he owns a landscaping company, right?
Yeah, so
Yeah.
he's gonna clean it all out. I gave him the job because I really think that he'll be able to bring us a buyer. I think there's a 50-50 chance that he finds a buyer and says, look, hey, I pay referral fees. You find a buyer, I'll pay you. You find any more houses, I'll pay you. And I cannot tell you now, obviously, if you're in another state and you're trying to do it in Texas, not gonna be that, you're not gonna get the advantage of doing that, but it doesn't mean you still could have bought the same house living in Ohio. I'm telling you right now. Because I think the person that we end up getting it from, they're not even local anyway. They're not even there. In fact, Douglas, when you went to go look at this house, did the representative for the company, the wholesaler, did they have anybody representing the company at the house when you went to go look at during your 12 to 1 o'clock inspection period?
No. I believe the original owner was there, and I think she was renting it out. But nobody from a wholesale company.
So no one from the wholesale company was even there,
No.
right? So there's no one was even there from the wholesale company. Here's my next question. How many people were there looking at that house when you were there?
Nobody.
Nobody.
And I was there for a little
I
while.
think we had a pretty good chance of getting that deal
Yeah.
because we were the only buyers on the deal.
Mhm.
So we'll get into the details on it later, but guys, these are everywhere, man. I'm telling you, they're everywhere. Anybody that says they're not there just isn't asking the right questions to the right people. They just are. So anyway, thanks for doing that, Douglas.
No problem.
There'll be more, I can promise you. So, all right, let's get to the Q&A real quick, and then let's jump on and go through a couple of these deals here. So let me pull this back up. First question is, when you are offering owner financing, what do you say when somebody is mainly interested in the rate? Okay, I think we had this one last week. I said, well, I mean, I'll say the same thing I always say. Well, if you want a lower rate, then go down to Bank of America, Chase, or Wells Fargo. And
So Nick, just so some of the new people on the call, we typically sell our homes at 10 to 10.5% interest. And so when you send it out and you're selling a house for $300,000 and you're getting 50,000 down on it, and you have a $250,000 loan at 10 to 10.5% interest, people start questioning, well, how in the world or why in the world would anyone?
I think that is an incorrect perception. I've literally done this.
You think it's incorrect, but the
I know
people that have never sold a house on terms don't understand it.
People that are selling the houses, they put themselves in the position of the buyer. And I'm telling you right now that the interest rate is not the reason why they buy or don't buy the house. I rarely get questioned on interest rate, almost never.
Well, let me just tell you today, the guy I was talking to, one of my investors, they do $50 million a month at 10.25%. So it's to owner occupants, fully qualified, fully underwritten borrower.
Yeah.
So it's really about home ownership, having the ability to own a house, having the ability to not be a tenant anymore, having the security of having a home, and not having to move every year or whenever the rents go up. These are fixed mortgages, okay?
I always say, what's the interest rate on rent?
Yes. What is the interest rate on rent? And the answer is there isn't one, because you're not paying down your loan at all. So the math works.
You got $1 back every month for the $1,000 you paid in rent. You can figure out your return.
Yeah.
Good, but you get $0 back. So there is no interest rate because right. But that's part of it. I just don't. People say the rates are sometimes a little high. They're going up higher. We're going to be creeping above 10 pretty soon here. And I never negotiate rate, never, and I will never negotiate rate, because that is the kiss of death when you go to sell your note.
And the reason why we create our notes between 9.5 and 10.5, it's affordability factor. All the people that we sell homes to get fully underwritten and can qualify for these mortgages. So when we sell, when you guys see here, when we do the model, you want to be able to, in order to get top dollar for your seller finance note, your first lien, you got to have it at a rate and a return that a typical investor would want to buy that note for maximum value.
Yield. They're buying it on yield. They're buying it on looking at time value money. 30 years is a long time, and they're also buying it based on the risk relative to the borrower and the asset. It's that simple. And you cannot get away. You cannot get away by lowering the rent. Now that rates have gone up, it's not nearly as big of a deal as it was 2 years ago. How hard of a job do you think it was me having to try to do this when rates were 2.5%, 3%, and we were charging 9.5%?
But Nick, so also, I was talking to one of my guy today. I says, "What's his average loan amount is just under 300,000, and but the term, this is something different for me, is that these are staying in place for just under 2 years." And so that's not average for us. Like our borrowers have no other option other than the loan that we gave them. They're not going to go refinance and buy other properties typically. And so our loans stay in place for 7 to 10 years. I have loans right now that are 11 years old. They're really, they've just been paying and paying and paying. I have one right now. I just looked at it. $1,758 a month. I've been getting paid for 6 years. 6 years. It's just a great deal. So anyway, what's the next question?
It says, if we buy a house with hard money, can you show us how to pay that off and do a second to get monthly income? So yes, if you go to creativedealmaker.com/video, that video analysis is exactly taking it down with hard money, creating a first and second, paying off the first, getting some cash now, some cash flow from the second note, for the income, and then the potential projection of what cash later would be based on a 10-year payout, I think is what we use. So, and we're going to show that. We're going to pull up a model here, and we'll show that here as well. Now, it doesn't matter how you acquire. You don't have to, if you don't use hard money, it doesn't matter how you acquire. You can use a lot of different ways to acquire, but we always want to structure. I always structure the back end the same way every time. Right, a first lien and a second lien, whether I stay in the deal long term or not, it doesn't matter. I always write a first and a second because I want options. When I have options, I can control. When I control, I can have a little bit more predictability on the potential outcome. So,
but Nick, the reason you do this is one of the things that's going on in the market. People are talking about subject to all over the place, right? They're teaching subject to how to take over people's payments, and don't worry about the note getting called due, and all the great things, and taking over 3% and 4% loans. And I mean, I have one right now. It's 15 years into the amortization. It's 4.875, which is high, but it's 15 years in the amortization. The thing's gonna be paid off in 15 years. But so my point is, I'm still gonna take over the payments. I'm still gonna create a first and second, because if I create a first and second and I create that first at a 10% interest rate, if there is a due on sale clause, if there is a situation or not a due on sale clause, if there is a situation where that note gets called due and I've sold the house and created a wrap, I'm still going to be able to get out of that note, okay, and not lose my second lien and all that equity that I did. And that's what we
get to at least stay in the deal if you choose to.
Yeah. The big challenges in this market is people are taking over sub two, and everything's great right now, Rainbows and all this great stuff. But if there's a challenge and a problem, they're not able to fix that problem by exiting out of the deal. And you're going to harm a lot of people. You're going to harm the consumer. You're going to harm the seller.
You don't want to be in that battle. I don't care.
Do it the right way.
Do not care what you write on the contract with the seller. Do not care. If you think for 2 seconds you got a chance in front of the judge, being an entity that does this professionally against a distressed seller, because that's exactly what they are when you buy it subject to. You better have all your T's crossed and I's dotted, because it's not a matter if something's going to happen, it's just when. And there's nothing wrong with whatever happens. It's just being able to know how you're going to respond. okay?
Yep.
Because really, at the end of the day, money cures all problems, and most of the time. All you have to do is go pay it off. So if you got $100,000 sub-2 deal that you wrapped, great, and it gets called, or the seller says, I need to go buy another house, or you just go pay it off. But if you can't pay it off, you better know how to get cash back out of it, which is why we create the first and second liens. On all sub-2 deals, we always create first and seconds, just so we can have that option if we need to. Because I would rather write a check for $10,000 net and get a $40,000 second lien on the deal than exit out of the whole thing and make $2,000.
Right.
Right. So, all right. I don't think there's any more questions unless there was some in the chat, and then we'll go to Joey first and then Amika second. Any other questions based on what we talked about so far? And we'll just go. We'll go.
I just heard your reference sub-3. Was that a verbal typo, or is there such a thing as a
It's
sub-3?
definitely not a verbal typo. It's for another call.
Yeah, well, why don't we, we're not gonna go over sub-3s tonight, but we can.
Because we don't really teach that. We don't really want to get into the acquisition side of it. There's guys that teach it that are much better than us. Our job is to teach the exit and complement what they're doing. Okay. So, but yeah, the short answer is it's just it was another creative way to acquire, but there's a lot of things that need to happen structurally to the way the whole deal goes out, and we don't have the time to go in today.
And we're gonna get with Joe. We're gonna do a couple deal or no deals, and then we'll go back and look at some of the questions in the chat, because we will have questions. We always do. So I'm gonna bring Joey.
Bring Joey on.
Let's see, Joey, do you have are you?
Hey, Eric. Hey.
How's it going?
Good. How are you guys doing?
Great.
Awesome.
Awesome.
I'm gonna see. Oh, I lost you. Where'd you go? Are you on video?
No, I can't get on video right now.
You can't? Okay, no worries. We'll just
I'll just pin him. That's okay. Hang on. I can pin him. Are we pinning or pinning, right? Okay.
yeah, I think you
I'll do all the spotlights and we're gonna pin him. There we go. Okay. Let me get a screen share. All right. So Joe, do you have a deal you want to go over?
I do. Yes.
Right.
I got a.
Do you have?
Yeah. I mean, just tell me where do you want me to start?
Did you create the model on it yet or no?
My business partner did. I don't know. I think Max may have. Max Brutus.
Okay.
You know, Max.
Yeah, I have it here. Let me see if I can pull it up real quick, and then I'll share my screen. Okay.
All right. Yeah.
Let me go here.
Is this the one in Georgia, Joey?
That's correct. And
Eric's pulling it up. Give us a little background on the deal, how you found it, how you're gonna fund it, what are you gonna do on, what are you thinking about doing on the exit? What do you think about doing on construction?
Sure. So first of all, we found the deal through an old direct mail campaign. Funny enough, we sent that campaign out back in February, and so she's been collecting, mail, I guess, for that whole time.
So if I hear you correctly, because I like to repeat what I think you're saying. You did an outbound mail campaign.
Correct.
And then you said you couldn't get them to say yes to a cash offer back then.
No, we didn't talk to him until just recently. She actually called in for the first time.
She called you in, so you didn't go back and recycle it. Gotcha. Okay, so they called in.
She called in, this last Thursday, and she actually was very buttoned up, knew what she was doing. She, she was trying to create like a bidding war essentially, but we had a pretty good conversation. Her father had passed away 4.5 years ago. They were hoarders. They had 3 estate sales already to try to get as much as out as possible out of the property. And long story short, I immediately went to the property that day because I knew that she was super motivated based on everything she was telling me. So we went and looked at the property, took photos, had a good conversation with her. Actually, someone else showed up while I was at the property, and I left her, with all my information, my reviews. We have local reviews here on Google My Business, so that gave us an advantage for sure. And I said, I'm terrible at negotiating. I'm really bad at this. But you just tell me what you think will work for you, and we'll try to see if we can make that work. So the next day she sent me like, I've never seen a seller do this before. She sent me like a list of like everybody's, like what they estimated it was going to cost to do the property and what they could potentially pay based on that. And, Brad Smotherman and Nick, they were like breaking down, like doing kind of the, Brad's negotiation tactic with,
Right.
the realtor fees and this and that and blah, blah, blah. And I was like, well, just, you tell me what you need. I was like, I can pretty much guarantee you I'm not going to be the highest offer. I said, but what I can guarantee you is that we're going to close, faster than anybody else, and it's going to be done. We're not going to renegotiate. In fact, I'll even waive the inspection. I still be no inspection. So you're telling me that you're not going to renegotiate with me and do some inspection. She said, everybody wants to do an inspection. I said, no. I said, I see there's some foundation issues here, but I'm not like overly concerned with them. We can get this done without an inspection. So long story
Nice.
short, that's what sold the deal. I mean, I got it for about 10,000 less than the highest offer. I mean, she straight up told me, she's like, can you beat 97.5? I said, no, I can't. I said, but what I can do is I can do this without an inspection. So we get locked up at 87.5, and the property's worth about 230, 240 fixed up.
Okay, is she living in it now, or is there a tenant in it?
It's vacant. No, it's vacant.
Okay. Was it
And
lived in before it went vacant?
Yes.
I
Yeah. So the
obviously
power's
saw that,
on. The
but-
power's been on. They haven't. Yeah. They everything's been on. The water, power, everything's good to
It's
go.
not like, it's not like dilapidated where somebody couldn't live in it, right?
Correct. No, they had family living in it not too long ago. So it hasn't been vacant 4.5 years. Her dad passed 4.5 years ago, but they've had family living in it up until about 6 months ago.
Gotcha. So we'll
Yeah.
look at it. We'll run two models. We'll run it one as is, and we'll run another one, fix it up. And we'll compare
I'm
the
gonna
two.
share my screen so you can see the model and we'll bring it
Okay.
up.
Hey, Eric, can I
Yes,
also,
sir.
I can share a link with pictures if that would also help too, everybody, if they
Yeah,
want
why
to
don't
look
you
at
just put it in let's put it in the chat. if you
Chat?
can, and
Yeah,
then
I can do that.
Yeah, throw
I'll
it
put
in the chat and then we'll pull that up. But here's
Sure.
for everyone who hasn't, can you please just let me know in the chat
You're
if
not
you
gonna
can
be
see
able
the
to edit
screen.
this. It's view only. You're not gonna be able to edit this.
No, I know.
Okay, well, we can't. There's not a lot we can do with it. We can't edit.
Yeah, I tried to get view. Yeah, it's still view only. I don't know if he was able to give me viewing rights, but
I sent a request ready to Max, but he didn't.
yeah, okay. Well, let's go through it so everyone can get it. For the people that have never been on the call before, they can get an idea of what the spreadsheet looks like. Obviously, you can get this
Can you-
spreadsheet it's in the chat under the.
Can you go down and hit right click on the address and see if it'll let you duplicate it at least? I don't know that it will. No. Okay. Okay. No.
No.
All right. So yeah, without being able to have control over it, it's gonna make it really, really difficult to.
To play with the numbers.
Yeah. But we can just look at it based on where it is right now.
Yeah.
So if you're thinking you're gonna put 40 based on this, you're gonna put 40 in it to sell it at 165.
No, I'm not sure why he put 40 in there. I mean, I'm thinking it's going to be about, an $80,000 rehab, but we were going to try not to put anything in it to start with.
Yeah, I wouldn't put anything in there if you, especially you can,
Yeah.
and price it accordingly. But yeah, I would probably see if we could take that out. So what do you think? You were in the house. I mean, can you get 154 as is?
That might be,
40?
well, I don't know. I mean, if you can look at the pictures in the chat, you tell me. I don't know.
Let's look at it.
I'm more of a flipper. So I'm the guy that wants to take it down
Yeah.
with the studs, like you're
No, I hear
saying.
you. All right, let's go ahead and let's pull up the pictures real quick. Let's see what they look like.
I don't see. Oh, is it? Wait, where's the? Oh, is that it right there? All right.
Let's see what they look like.
Is this it?
That's it.
Okay.
Yeah, I already seen enough. I don't need to see any more. I literally, I don't need to see anything else.
So you think you can get 150?
What town is it in?
Columbus, Georgia. We're an hour and a half south of Atlanta.
Yeah, what's the population? About 100,000?
Second biggest city in Georgia. We're about 250,000.
Yeah, okay. So that's bigger than Savannah?
Same size. We're the same size as Macon and Savannah. We go back and forth between being
Gotcha.
second and fourth biggest. Yeah.
Yeah, I don't think, I mean, I would not touch that house.
No, that's fine. So now, yeah, it sucks that we can't have the edit version, but as you can see
You
here.
know what, you know the numbers, Joey, I'll just go ahead and, let me just start another. Let me
Sure.
just do this. Let me go I'll just pull up another, because I want to run it 2 different ways. Give me 1 second here.
Okay.
Let me pull up my screen, let me pull up the model real quick. Let's see here. Gotta find. I think this is, I'm in the middle of doing some updates, so let me see if this works.
I'll stop sharing and you can share your screen and we'll go through and I'll
Yeah.
read out the numbers. So at least we have
Yeah,
that.
give me 1 second, make sure I get the right model up. Still opening it up.
But these are like this particular property that they have, Joey Max have, it's a bread and butter. These are all over the place.
Let
That's,
me share my screen. Then we'll make
okay,
it
I'll
quick.
stop share, let you go in. And then we'll talk.
All right, so the first thing I'm gonna do is I'm gonna create a new one here. Oops, it just moved. Hang on. It's jumping all around me. Duplicate. What street is this on?
What street?
Yeah,
What-
I gotta name it.
You want a street on
I
it?
just want a street name so I know what it is.
It's on
Belanca.
Belanca, Bellanca Belanca Street.
BA.
Bellanca
Got it. Yep.
Okay.
Street.
Let's call this one Blanca as is. All right, great. So let's go up here. I'm not gonna fill all of this stuff out. So let's go up here. Acquisition price was 87.
87.5.
Yep, 87.5.
Okay. We'll solve for sale price in a second. Down payment. Well, so we're gonna put, I'm gonna put just two. Do you think it's gonna cost 2,000 to clean that out? Probably not, right?
Oh, no, I don't think so, not at all. Probably 1,000 to be
All right, let's
generous.
put 1,000 in there, okay? 1,000 in there. Let's start the sale price at, let's just start it at 150, okay? Start at
Okay.
150. So we want to, if we're not gonna do rehab, I want to see at least 8% down. Doesn't mean a lot, so I'm just gonna call it about, I'm just gonna put in 12,000 to start with.
Yep. Minimum, and we typically, when we do seller finance deals, we'll typically not take less than 10,000. And that depends on the property and what's going on, but this particular property looked pretty decent, actually.
Yeah, I think we could probably get a little more. Do you know did you run the ZHVI on it by chance?
No, I'm not sure Max did all that, so I couldn't say.
Do you know what new people on the call, ZHVI is Zillow Home Value Index, so you could, so if we found the zip code, we could run a ZHVI right now and just show you kind of how we do it.
Do you have a zip code for it?
Yeah, 31909.
Okay, so this is one of the things we do to get kind of a general idea on what.
Say again what it was.
31909.
Okay.
Is this for like the rent, to kind of what to rent for?
Oh, no, what I'll show you here, it shows the median home values for the area.
Oh, that, yeah, right.
And what
Okay.
the change has been in the last year, so. the
Hey, Eric,
median home price-
Nick,
What's that?
sorry, I just have access to the file if you can. share
That's okay,
your
I've
chat.
already got the other one started, thank you though.
All right,
It's not a big
So,
deal.
yeah, no worries.
So the median home price is 151, so if you think the ARV is 2 something, that's gonna put it way at the higher end of the range for that zip code. That's not where we wanna be, but I think that house, this is probably right smack in the middle. I'd probably set the sale price at 150 on this one, let's see.
Yeah, it's a bigger house for that area. I mean, it's not huge. It's just, it's 2185 square feet. So it puts it, probably
Right.
about 25% bigger than the average house.
Okay, well, that's okay, we mean, oops, hang on. All right, so let's go on down here. So how are you gonna take this down? Hard money, cash? What are you doing it?
We're gonna get a loan. I believe we're gonna get a loan at 7%. He's
Okay.
got a Yeah, he's got his guys. He's going to get, I think 7%. He said. I also know.
We're not gonna mess with it. We're just gonna leave it at 12.9. It works at
Okay.
12.9, it's gonna work at 7. Okay,
Sure.
so let's go down here. So.
Yeah, that was worst case
So
scenario.
just so everybody knows, like what we do is we'll go get 100% financing with our lenders at 12, we'll pay them 12.9% and 2 points. If you can make it work at 12.9 and 2 points, you can make it work at whatever rate. If you can go negotiate a better deal, then go for it, right? That's why we do
If you're
it.
not gonna fix, I'm just gonna put, if today's the 12th. And let's say you have to hold it for 60 days, it probably won't be that long. If you're not doing repairs, you can probably get it sold faster than that. All right, I'm just gonna put it as a placeholder in here, okay? Any idea what the rent value is in that area?
Yeah, I got it. I'm gonna pull it up. It's about 16 to 1700. Probably is the median for a 4-bedroom.
Okay, I'll put 1650 in there, okay, good. All right, so let's look at this. The first thing we wanna look at is this right here, okay? These, the small area right here. And what it tells me right now is that based on at $150,000 sale price, acquiring it at $87.50 and getting $12,000 down payment. When we close it with the seller finance buyer, the cash that we're gonna get at closing is gonna be $1,632, okay? Not a lot of money, but it's not negative either, right? So that's the cash portion of it, okay? So, you know, if you're at 7%, you know, you can change this up to 7, it's gonna change it a little bit. Okay, cash is gonna go up to 2,500, okay? So here's what we gotta look at.
So real quick, let me interrupt because see the difference between 7 and 12. It's not even worth thinking about. That's why you want to pay your investors whatever you want.
If you're not in the
You're
deal
in and
long
out of
enough,
these
it's gonna be
deals. You're
different.
not holding these deals for, if you held it for 12 months, it would be substantial. If you're holding it for 60 days, it
800 bucks.
doesn't matter.
Doesn't matter at all. So, well, so you got a question you need to ask yourself. So, you know, is that the right acquisition price? I'm saying, yeah, probably so. Could you sell that at 160? Well, if we put 160 in, let's see what happens to the numbers. Your cash is gonna go way up. It went up to almost $8,400, okay? Okay, that's good. So I don't know, but we want to model conservatively and then see what we can get, okay? So in this model, I'm gonna leave it at 150. We want to model it worst case, but we were gonna try to get more for it, okay? I think that house cleaned up in that area is probably can get maybe 155, 160. I think you can probably get 15 down also, okay? That's where
That's
I
what we're
would
going
start
for.
at.
Yeah,
that?
we're trying to get. That's what we're trying to get exactly. Is 160 with about 15 down. That would be
Yep.
ideal.
Well, that's great. So, we want to model it conservatively. The other thing that's in here, that's a variable, it's got 4% marketing in it, okay? So 4%, I mean, if you list it and sell it your house yourself, or you have somebody that can do it for cheaper, it's just gonna save you money. But we always want to model it at, you know, worst case scenario. That's why we do 4%. 1 to list it, 3 to sell it. That's it. You can't, not gonna cost you anything more than that. Okay, so that's it. So now the question is, let's go up, I'm gonna pretend here. You're able to get the 160 and 15,000, okay? Let's just say this is what you actually get, okay? Because now you got a decision to make. Okay, so 3 weeks ago, you did the forecast, and now you actually got the real numbers in, and the real numbers are 160 and 15, okay? Now let's go down to here. So the question now becomes, do I really want $11,000 cash? That's a question you need to ask yourself, right? Do I want that much cash, or do I want a bigger second note? Because, you know, if you defer the cash into the note, it's going to pay you more over time. So let's just look at this for a second. The way that you can do this, say you didn't want any cash out of the deal at all, okay? You want the second note right up here to be as big as you can get it, okay? Right now, it's $29,800 and $256 a month, and we'll look at the amortization table here in a second. I'll pull that up, but let's go through this scenario.
Now keep in mind, your $1,246 payment plus taxes and insurance is still under market rent. So there's a lot you can do on this deal to get to market, right?
Yeah, you might even be able to get more than that, but I don't know what taxes and insurance are. But look, if you can make the all-in payment equal to or less than rent, you
Yep.
can charge higher for that property,
Yeah,
right? That's what Eric's saying. So, I mean, if taxes and insurance are $300 a month total, probably more than that, but maybe they're not.
A little more, but not much. Probably just over that, 325 maybe.
Yeah, so that puts you
you're,
at
so you're just
25.
right, you're dead in line with where you want to be. That's why these,
You might be able to get another.
I
you might
love
be able to squeeze another
I love the
$50 a month.
150 price points. I love it.
All right, so let's go down here for a second. So let's just say, for argument's sake, that you don't want any cash, okay? You want to break even on these deals, okay? Or even invest a little bit. So the only way you can change this number right here from 11,000 in cash is you can change the note ratio, okay? I'm going to change the note ratio to 70%. So what we're doing is we're adjusting the first note value and we're lowering it, and then we're going to increase the second note. Because the lower we can write the first lien at, percentage wise, the less we're giving out in the way of the discount. Okay, and we get to keep all of that. So when we change this to 70%, now it goes down to 86.25. I want to keep going down. Let's go down to 65. Watch what happens to the second lien. It was at 28.5 before. Okay, now that's at $1,500. Now it's a $41,000 second lien, and the cash flow is $352. Okay, that's a big difference. Because when you take the cash, two things happen when you take cash. Well, a lot of things happen when you take it. Number one, you're paying tax on the cash. It's that there's no other way around it. It's the short-term capital gains. It's income. It's income, and there's no other way around it. When you carry it back and you don't take the cash and do it as an installment sale to the buyer, it's treated differently. That's number one. Number two is that you're collecting amortized. We're going to go look at this real quick. So this is 41 and 352. So let me pull up an amortization table and let's look at the difference.
But honestly, so what a lot of us do when we're doing note creation is we like to have a little bit of cash to pay your bills, pay your marketing costs. You know, if it's 5 to 10 grand, it's fine. But even at 5 to 10 grand, you're still having a nice big fat second lien that when we sell and this will answer one of the questions we had earlier is how do you get rid of the hard money or that initial expense to have a free and clear second. So
let's look at that here first, and then I'll pull up the amortization table. So right now, let's look at it right here. So this number right here, this 1585 net cash is the summation of the money you get from the down payment, the marketing fees you pay, the cost of your capital, and paying off the first note, and the net of that is the cash. So right here, it tells you that you're going to get $91,520 for that lien that you're writing at $104,000. That's what that means. Well, if you owe 88 or 87,500, you obviously got the money back, right? That's what it's for.
And then when you sell the first lien, that's what pays back your initial cost and gives you a free and clear second. And this is why, for us, when it comes to risk, how many BRRRR methods do you do if you're a buy and holder, a turnkey buyer or whatever, that you make $352 a month and you have none of your money back. And it's harder now than ever to get to do the full BRRRR model and get all your money back because of the way interest rates are going, and the lenders aren't actually. You're still going to have money out of pocket. We're actually having no cost, if not money in your pocket, and get the $352 a month. And then obviously Nick's going to run an amortization. So explain to you the appreciation.
What was it? 28.5 was the first number, right? 28.5 was the first amount of the second lien with taking the cash out.
Yeah.
That's right.
So we're going to see the impact of taking cash. That's what I want to show. Because you can get cash, this might be the fifth deal of the month. You don't need any more cash.
Right.
You might already have you've been wholesaling and you get cash from the wholesaling deals, right? So you don't need, it just depends on where you are. You may need a lot of cash, you may not need any at all. So let's look. Let me go to my note calculator here. And right now we're at $41,000 in the second note. So right now you're going to make the cash now is $1,600 cash now. The cash flow is $352, and the cash later on a 10-year payout is another $37,000. So your 10-year projection payout with no risk because your risk goes away immediately as soon as you pay that first lien, as soon as you sell that first lien and you pay off the debt, right? Right here, when this happens and you sell it, that seller finance buyer, you're out of the deal. There is no cost basis. It's zero, right? Because you paid everybody off. The
So
only
what
thing-
you're saying, Nick, is you got, if you take the 352 times 120 months, if this goes 10 years, which by the way, the people that we're selling our homes to, they don't have other financing options. They just want home ownership, and they typically stay longer than the average buyer or borrower because they're not going to go down to Chase and Wells Fargo and get another loan. They're just not the traditional banker, but they're phenomenal borrowers. So you take the $352 a month times
I'm gonna
120
show it in the amortization table. This-
Yep. Yep.
Right. But my point is that in this model,
just on the second lien, it's 81,000.
right now, this is cash now, cash flow, cash now 1585. Now, if you want more cash, you can change this up to 72%. I wouldn't go any higher than that, okay? Because that's what's gonna guarantee.
So you never want to create a first lien right now in today's market at more than 72%. Your first lien's at 72%. Just remember that. So when you're creating your first and second lien, stick to that number because that's where
You got,
you're going to get max value when you sell your first lien.
but if you're
Okay.
using the transaction process that we have in place, we'll never let you do that because we're never gonna let you write it for 82%.
Right.
That's why we have you follow. Remember, we talked about the 4 things you do: find the deal, fund the deal,
Analyze it.
sell it. Did I say anything about setting up first and second? I said that you need to figure out how to set up the first and second. Did I say anything about how to figure out what interest rate you're gonna charge, who the service you're gonna use, who's gonna underwrite the deal? Didn't say anything like that. Because you don't need to do that. I don't want you to do that, because if you do it, you'll screw it up. That's just the truth. It's just the truth. You just will. Because you don't know what, you guys aren't note buyers in that perspective. You maybe real estate investors, but you gotta understand how note buyers think. and what-
For the new people on the call, just so you guys know, Nick and I have brought the note investing world to the real estate investing world and brought it together. And then we're able to monetize. When you guys learn this, you're going to monetize off that by bringing, because there's a note investing world that nobody even knows about. And then there's the real estate investing world where you go buy a house at a discount and create, well, you can buy it at whatever you want, but by going and adding value or just getting a deal on a property and then selling it on terms, that's what we do. So anyway, go ahead. This is a good one to go through. This is a really good one to go through. I love it.
So let's look at the bottom of this real quick, then we'll look at amortization. So if you take the cash now, okay, max cash out now, the total value of over a 10-year projection of this deal is $69,000 total. That's cash now, cash flow, cash later, okay? If you go back and you say, I don't want to take all my cash out and I'm okay doing less cash, it goes from 69,000 all the way up to $81,000 just by shifting how much the first and second lien is. So by deferring that money over, you're gonna be able to make more money. Now, the question is, you need to do with the cash. Now, we're not taking the taxation and all that stuff, which is an important factor to take into consideration as well. Go ahead.
So Nick, one of the things that I want to share with the newer people on the call tonight is our amortization is our appreciation. Okay. So when you're talking about, there's nothing wrong with owning real estate. Like single family homes are our cash flow, which we love. And then we go buy multifamily to offset our taxes. That's what I do. That's what Nick does. There's other investment vehicles you can do, but having single family homes as rentals is just not what we do. It's just, there's too much expense. There's too many unknowns. When you create a note and you get a really qualified buyer who has a family and they were tenants 2-3 weeks ago and now they're homeowners and they qualify for this type of house. I mean, it's just the best. It's the best deal. It's such a great, it's a feel good business, but we also make a good living doing it.
Okay, so let's look at the amortization table on the 41,000, right?
So you go to noteunlimited.com, it has a calculator there. That's a free calculator that we use. And we like to run this model. So it kind of gives you guys an idea of what we're doing and how you can see the math behind the power of amortization and being the bank. And that's why we do this. That's why the banks do it, right?
So even though this $41,000 there's no cost base on, that's your profit on the deal, right?
So you're basically getting paid interest on your spread on a flip that you didn't do any rehab to, okay?
Not only are you getting paid interest, you're getting paid amortized interest.
Nick, real quick, we did a deal on Fortune. How much down payment did we get on that?
I don't have to pull it up. I think.
Well, just guess.
$15,000.
$15,000. Okay. So someone put in the chat, do you have people that have large down payments? That was just that's a deal we just closed.
I just did a deal in San Antonio. I got $100,000 down payment on a $170,000 house.
There's more down payment money than you believe for people that are tenants, because people are tenants because they have to be, not because they want to be. So people want to be homeowners. They want to own a piece of America. And there's people out there just looking for these opportunities. So every market's different. So I'm not going to say there's $15,000 to $100,000 down payments in every market, in every community, but there's enough, because there's 5% of, well, I'm being conservative. If you have 70% of the market that is that's unable to get a bank loan, okay, and only 5% of the market sells that lists properties for terms, which is very high. It's probably closer to 3%. So you have a supply and demand. If you're the one selling houses with terms and you have 70% of the market that isn't able to get traditional bank financing, you think you can find a buyer. Nick, have you ever not found a buyer? Have we ever not found a buyer? The answer is no. We've always found a buyer.
No, there's always a buyer.
Yeah.
You may have to adjust your down payment or your price, but there's always going to be a buyer.
Yeah.
Buyer for this.
Yep.
So let's look at this amortization table real quick. This is important to see visually. Okay, so this note, $41,000, no cost basis, right? Do you owe anybody any money on this note? Which this is your profit on the deal, right, Joey?
No.
Yeah.
You don't have to go get a loan to do the Burr model. To do the Burr model to get $200 a month, and you put up 20 or 40,000 down, and you still owe that money. So when your tenant, destroys the house in the first 8 months of the deal, you now have to go fix it up, and you're in a never-ending disaster. Okay, that's why we do this.
I'm curious if anybody's got a rental property or rental properties, what the value of that rental property has to be to net $352 a month.
Yeah. Yeah.
That's what that is. That is it. There is no hidden fees there, man. That is going straight into your bank account every single month, as long as they pay. And if they don't pay, and you can't cure the problem, guess what? You can foreclose for the second.
But guess what? Guess what happens if our borrowers, which knock on wood have been really, really, really good because of the way we underwrite them. Guess what happens if they do default? You don't owe anyone any money. It's just a matter of time, and interest rate starts kicking in, default interest rate. And yes, could it get foreclosed and you lose your equity and your second lien? Possibly, but there's still opportunities.
Maybe you only get $15,000 back instead of 41. Okay,
yeah, it's still
so you made 15,000 plus all the cash flow. But there again, look, that's not. I don't consider that risk because there's no cost basis.
So Nick, let's go through this deal and show what the payout over 10 years would be.
Show here is that even though the face value of the note is 41,000, the 30-year payout over time is $126,817. Okay,
if it goes 30 years,
if it goes 30 years, which is possible, but let's just say that only goes 10 years. Okay,
yep,
we're getting $352 a month. Let's just do 100 months. It's easier math. Say in 100 months it gets paid off. They sell it, they refinance it, they pay it off, whatever reason. So the game is over, right? Because you're going to get paid off. Well, they're going to call for a payoff. They're going to call the bank. Well, who's the bank? You're the bank. You're going to give them a payoff, and you're going to go down, and the servicer will do all of this. They'll get a payoff amount, and we're going to go down to 100 months. And that $41,000 note that started 100 months before, you're still owed $38,066.
Plus you got $35,200 in payments.
So what you got is whatever cash you got when you did the deal today, or 10 years or 100 months ago now. You got $35,225 in cash flow.
Nick, so you're telling me that $41,000 loan that I paid on for 100 months, I still owe $38,000 on? Is that what you're
That's
saying?
Exactly what it says.
Okay, I just want to be clear. That is the power of the amortization on what we do, why we do what we do. That's it in a nutshell.
The banks learned a long time ago how to create. If banks really cared about depreciation, they'd figure out a way to get depreciation. This is way more powerful because guess what's gonna happen? They're just gonna be, the banks is gonna do it over again. They're gonna get all their money and go do it again. It takes, in this model, what people don't realize is you can see in this interest and payment and principal, it's all front loaded with interest. So let's look at this for a second. So in the very first month, the payment is $352, right? The very first payment that borrower makes to you, they only get credit for $19 against the principal pay down, and $333 goes to interest. So you're getting all your interest first, okay?
Hey, but Nick, what happens if something happens to the roof or the AC or the hot water heater or the plumbing or any of that? Who pays for that?
Well, the homeowner does.
The owner does, right? So you guys have to ask yourself a question. If you guys are on this call, when was the last time you called your bank to ask them to help you repair your roof? When was the last time you actually called your bank for anything other than get more money?
Yeah, don't.
You don't. So how many, if you're never getting called and you don't have to pay 40% in taxes and insurance and repairs and vacancies and property management and whatever else you think you have to pay for, and a mortgage for that matter.
Right.
This particular deal would be a negative, almost a negative cash flow deal, and you're just banking on them paying down the mortgage over time. It's crazy what happens. So that's why
the other models all work. There's nothing wrong with
oh
doing
yeah,
that.
they're great.
But there's risk in every other model because when you don't have liability or you don't have any liability on this property, you don't have any cost basis on it either. So you don't owe anybody anything once you sell that first note. Okay, so let's look at this real quick. And we talked about it. So I want to show one thing and why being the bank is so valuable. You get all your money first. So let's just say you let somebody borrow the 41,000. Okay. Well, in 100 months, that's 35,000. So, you're looking at, I don't know, you have to do the math on it, 41,000. Every month that goes by, your risk is mitigated because $352 comes off that amount, right? So in a year, you got about, what is that, about $5,000, $4,000, right? Now your risk goes down, but here's what's cool about this. It takes, I don't know, on this rate, I'm going to say it takes 23 years for the payment, the principal and interest to be the same. What I'm saying is that the payment never changes to the borrower, but what does change is how much gets applied to interest and how much gets applied to principal. So right now, it's very negatively skewed, or not negatively skewed, it's very skewed toward interest bias versus principal paydown. Still making a $352 payment, but you're the bank, so you're getting $333 of it, and you're only knocking down their balance by $19.
But you don't have any cost in the deal, so it's just like having a bunch of
No, I
zero
didn't. So my
cost
point is
debt.
that's why when you go out 100 months, they still owe you $38,000.
Yeah.
Well, let's just look at how long it takes for them to get to a 50-50 payment split between how much goes to principal and how much goes to interest. It's going to probably be 240 months, so not more. I think it's 260. Let's see what it is. Keep going, keep going, keep going, keep going. Look, at 240 months, 20 years, they're still paying 2 times more interest than they are paying you principal. That's why it's being the bank is such a valuable tool to have, man. There's no question about it.
Right.
Well, let's see how far it takes to go. Okay, there we go. We're close right here. Here it is right here. This is it right here. Payment 275. It takes 275 payments, actually 276 payments.
23 years.
More value going towards your principal pay down than you are going to interest.
23.
It's not even a bell curve, right? It's like way up for you to interest, and then all of a sudden it drops off because once you get the interest, then it starts paying it down. So 276 months out of 360, what is that? I mean, that's 22 years.
23 years.
I was close. Yeah, 23 years. So that's what you're saying. What I'm saying here is it takes 23 years of payments that the borrower is making to the bank. Who's the bank? You're the bank. Before they start getting a 50% of what they're paying in, they get value back on. That's the principal thing. It is a crazy thing, but here's the beauty of it from being a bank is that they're not going to even go 30 years, right? So since it's so skewed to the interest to our benefit as being a bank, if they go 10 years, they still owe you almost the entire principal balance. Let's go out 10 years. It's 120 payments right here. They've
And
only
they only
paid
pay the
down,
thing down $3,500. What? Yeah,
they paid it down
$3,500.
almost $4,000 and you collected $35,000. Okay, that's why we do this. Okay.
But here, just so you guys know, let's just think about it. You've given somebody home ownership. They have the same payment. The only thing that might go up is taxes and insurance. Okay. They have a security of having a home for their family. They can do whatever they want to the property with, this isn't a lease purchase. This isn't a land trust or agreement for sale or a contract for deed. They own this house. They're the owner of the house and they have a place to live with their family for as long as they keep making the payment until they pay it off. And so you think about that versus being a landlord. I mean, we don't have to dig in this any longer. I mean, you guys can figure it out. I mean, and then here's the best part. Like I have notes in 4 states now. There's nothing to lose sleep over. I just get paid. I have them set up in servicing. My servicer has a great platform, a particular, so we have them in all these different states. So we can do this anywhere. And it's just a matter of finding a team of people or yourself to go out and find these opportunities and provide homeownership for your community. So if you just do it in your own city and state, like, there's enough seller finance deals in Arizona and Texas alone forever.
Yeah. Hey, Joey,
one little guy that I work with, he does $50 million a year, and he's just some random guy that provides lending. And guess what he doesn't do? He doesn't go find the deals either. He's just lending at par. So that's the benefit that we have. That's why you guys are on these calls. You guys know how to go out and find or can learn really quickly how to go find discounted properties when you know that you have a seller finance buyer in the back end, because the majority of the market is your market. Right.
You guys go find the deals. We'll help you structure them and get out. Because at the end of the day, Joey, how many $41,000 free and clear second notes do you need to make a difference in your, in your life that pay you $352 cash flow?
Yeah, not that many.
Not that many. Look, if you could do one of these a month for 5 years, I mean, that's 60 of them. It's $20,000 a month in cash flow. But you guys got to understand that this is not the real number here. I mean, it is the real number. This could be the number here because of the power of amortization.
And as the market changes, there's other opportunities as well that Nick and I are actually, if you do buy the digital product, you're what do you call it? Grandfathered in, because we got some other really cool stuff that we've been working on. So Nick and I started this about a year ago. We've got a great, we've got 4,500 people in our Facebook group. That's where all the activity happens in there. And then we take that activity and the questions and Q&A and some of the case studies, and then we bring them to the group. So you guys who are on the call right now get the opportunity to listen in on what we do. Obviously the replays in the Facebook group, but that's what I put in the chat. How many 352s do you need to be financially free? Right? Like that's what I look at. And so I know that when I have my notes and I create them from scratch. So Nick and I are note buyers too, right? So we purchase notes that were already created. We know how to underwrite an existing note. But I will honestly say every single deal that I've started, just like this deal right here that we did with Joey, you found the house and then sold it on terms. The default ratio is so low. It's very, very, very low because we found the house at a discount, and then we're able to find a buyer and underwrite them and know exactly. And here's the best part: our investment, our like Nick and I, we buy the notes that you guys create at the highest value that we can, because we already know how it's created. We already know the paper. We know everything that's been done on it. So that's kind of that's the benefit of why we created this community, right? That's why we did it, so. Any other, so do we have, okay, we have, Amika has a, you have a deal you want us to look
All right,
at?
Joey, thanks for doing that. Hey, real quick, before we shift over, does anybody have any specific questions relative to what we just went over? I want to make sure we address them while we're still talking about this.
I have a question. You were
Okay.
talking about reducing the percentage of the first loan to 65%. If it's a lower, which is a lower loan to value ratio, can you get more when you sell that note, or is it still 88%?
You know, they're again in the model and the forecasting, that's what we forecast it as. But yes, there is a chance you get more. It's not linear though, right? So you go right at 42% first, doesn't mean you're gonna sell it 109%. Doesn't work that way, right? Because there's still risk and there's a lot of factors that go into it, such as the asset itself, the location, the borrower, a lot of other things that make that answer up. Note buying is very subjective at the end of the day, but in theory, the lower the investment, the value is, the better we're gonna get on a pricing point. It just really depends. It also depends on where it's located. You know, if it's in a tertiary market, you know, it's not gonna be nearly as valuable if it's in a primary market. There's judicial, there's non-judicial. So we just say, leave it at that. And we may get a little bit better, but not all states are, like, we actually get in Texas, we might get 91 or 92%. But we still model it at 88, okay?
Then that's just a bonus, but we want to be conservative on these deals. And if you're going, Virginia, are you direct to seller?
Right now, no. I'm going through agents, real estate agents.
You are, okay. I just talked to someone today about that, and we're actually buying their first lien. And so we were talking about some of their strategies and different things. And so it seems like he said, I struggle with agents because they don't understand how to explain it. And so what we do is what he's doing is he's just writing the offer. Okay. And then he asked the agent, hey, you're going to get paid here pretty quickly. So can I just be direct with seller so I can actually explain the process? And the reason we do that is because they might be able to give you terms too. You know, why not? Right. And a lot of deals right now is people are like, well, if I can get some terms and give you some income, because a lot of people, here's a perfect example. Someone just refinanced the house in May. They got a $55,000 of cash out on this deal. They've already spent all the money and now they're in default. And now that's where I'm coming in to say, okay, how can I help you guys get out of this? Some people I would rather have 0% interest loan and get monthly income so they don't harm themselves by spending all the cash, because they're not able to handle it. They're not able to handle the responsibility of large sums of cash. So we as real estate investors, we have the ability to help other people, help all the parties in play by making good business decisions and helping them from themselves, really.
Yeah.
So,
all right, good.
Virginia, real quick, what market are you in?
I'm in Florida,
You are, okay.
Central Florida, Tampa, Sarasota, in that area.
Good.
West Central Florida.
Good. That's a good market too. A little bit different rules on foreclosure and stuff, but but the price points are very, very good for this kind of structure in Florida.
Yep. Cool. All right. I'm gonna do we want to get Amika on I hope I'm pronouncing that right.
Yeah, let's do this and then we'll see if we have time, anything afterwards, and we'll wrap it up. All right.
Hey, what's going on, guys?
Hey, how's it going? Do you have the model or you just have a specific question?
This is my first time actually seeing the model you guys going through. I do actually have a deal that I have like broken down and everything, like my background, right? I do actually have a deal that we have broken down. I have locked up on a contract that we're looking at wrapping. So it's kind of new for me, most of the stuff, but I think I'm getting the hang of it. So I wanted to just like go through with you guys. And then my biggest question for what we have is the first, I guess the two notes part that we're going to be selling. So that's probably the biggest part of it. But yeah, I got a deal here that we're working on. that already got locked up. I can
You go
through
back
it.
in and, put it in the model, okay, do that. So let's just talk at a high level of what it is. So.
Do you have it? Do you have the model opened up and filled out or no?
That was I just downloaded it right now, so I got an editable format opened up here.
Well, we can just walk through it real quick verbally. Where's this property located?
This is actually in DC.
Okay. Let's see.
It's in DC. It's pretty much like a renovated property. Story behind it is, it was a cold call lead. Seller had it listed on the market. It was kind of one of those renovations that was a good renovation, but not up to quality standards of like the top ARV ones. So
Right.
he was asking for that price, sat on there for a little bit. So we basically got.
Well, let's just walk through this model real quick. Let's just punch it in. This is how fast it takes you to get a preliminary number on it. So I'm not gonna put the address in.
Give us,
What do you
just give
want?
us the street name, then we can fill it out.
Who's sharing screen right now?
This is me.
Okay,
This is
good.
me.
So perfect. Go put the asking price in. We're only concerned about the yellow fields right now. So put their
Okay,
asking
awesome.
price in. We're gonna see where we need to be on this, okay?
All right.
What do you think you can sell it for?
So we're trying to sell the note for 482.
You're trying to sell the house for 42, but you're buying it for 455. Is that correct?
Correct.
Okay, perfect. No, this is great. Okay.
Yeah, you have to do any repairs on it?
No.
Well, the first thing you can say before we go any further, it tells you what the minimum owner finance value needs to be to be cash neutral based on the acquisition price. So right now, you're off about $170,000 to the bad. That doesn't mean you're gonna lose $170,000. It just means cash is gonna have to come someplace else. So let's go. The other thing we may have an issue with that higher price point house is being able to get a first lien at 9.75 because the cost might just not be it just may not be affordable for the bank.
Now that we personally, Nick and I don't focus on anything more than about 300 grand, maybe a little bit higher depending on the deal. But I mean, I just helped a guy that this week, they did a $1.3 million loan at 10 1/4. So it doesn't.
No, but what you can do here is that you can get it contracted and then go find your buyer, right? That's what you can do with this. It's like, instead of trying to guess what you can do.
Let's put the numbers in so you guys can see like where this might go wrong and not, right? So
All right, so let's go down, let's go down payment. Let's put $50,000 in the down payment there. It's that yellow second column. Yeah, go right there.
Yeah, so down payment to him is actually 20.
No, this is are you buying this on seller finance?
Yeah, so we bought this on, so this is basically like what the exit was, right? We got it on seller finance. We were going
Is seller owner free and clear, or do they have an underlying debt on it?
own it free and clear.
They do. Okay, that
Yeah.
changes everything up a little bit. But
Yeah, so they own it free and clear. We got a seller finance and we were going on a 5-year balloon, and we were going to wrap this to basically like a wrap buy.
gotcha. Now, what's your term on the underlying negotiation?
The terms on the underlying, so it's 455 total purchase price, 20K down, 5% on a 5-year balloon.
5%
So-
on 5-year balloon, okay?
Correct. So altogether, monthly payment, including taxes and insurance, probably come up to about 2,200.
Okay, we don't really care too much about taxes and insurance because our wrap buyer is gonna be responsible for that anyway, okay?
Right.
So,
I can show you pictures of what this looks like, what the house looks like, but
Yeah, it's nice. So he's selling it to you for market value at a hair under market interest. Okay.
yeah, so our plan for this was.
Could be an Airbnb.
Right. Our plan for this was to essentially, so wrap this at these terms here essentially.
So
I don't know, 455, 5-year balloon with 20K down to the seller. We were, assuming closing costs and everything, and our fee that we want to get on the back end. Our assumed down payment for our wrap buyer would be somewhere between like 60,000, and then the idea that we were gonna go here was that we were gonna use private money to close in it ourselves and then give us time to kind of vet out that rat buyer with either like an RMLO or something like that, just give us a good chance of finding a good quality buyer that we could, you know.
Because you don't have the 20,000 to put down on it right now?
Well, we have a private money lender that we're working with.
Are you putting 40,000 down or 20,000 down?
So it's gonna be 20,000 down, but with closing costs, probably closer to 40.
Oh, okay. But the extra down, but the new loan amount's gonna be 435. So Nick, can I, here's what this scenario is, there's a couple things, what's a rent in that area? What's rent typically in that area right now?
So rent for a property like this is roughly about 2,500.
Okay.
So our idea was to wrap this about 2,700 a month. So we would probably get about $300 to $350 a month in payments on top of
Well, let's just look at that. Actually, give me, let me see if I can share my screen. Let me go back up. Stop sharing your screen for a second there. Let's look at this a little bit different way, because the modeling is probably not the best use of this. Let's just look at what this thing is worth in 5 years. Okay. Yeah, that's probably a better thing.
The challenge is if you sell this to somebody, you know, to an owner occupant, this is where I think Nick's going, is you're going to borrow a 5-year term and sell on a 30. So you're borrowing short and selling long. You got to be real careful on that. Plus your interest rate is market. There's a lot of scenarios here, but we'll break it down and see if it's something that.
So what are you buying? Let's just look at the financed amounts. Okay. So what do you finance with as a buyer? What are you buying it for?
We're buying it for 455 total.
And you're giving 20 down, so you're financing 435.
435. Yep.
Yeah. 435. Yeah.
All right, let's use 5%. Okay.
Mhm.
Are you still getting that on a 30-year term?
The amortization for that, so this is on a 5-year balloon.
On a 30-year amortization,
right?
30-year am with a 5-year balloon.
So
Good.
here's what you have right here. Okay. 2335, does that payment sound right?
Yep.
All right, so let me open another one of these up. So if you sell it, and you get the down payment from your buyer, how much are you financing your buyer? What's the finance amount going to be?
So the financed amount is basically going to be about 425.
I mean, you're selling it and you're getting 60 grand down, right?
Right.
I just want to look at the finance price though. We'll look at the cash in a minute.
Yeah.
25.
7.25, is that what you had?
Yep.
Okay.
That's just not. We'll have to solve for the yield here in a second, okay? And then let's
7.6 was the interest. Sorry, 7.6.
all right, let's do 7.6. Okay. So that payment comes out to be
That's 7.66, but whatever, it's close enough.
so that was a 7.6 or 7.66? 7.6.
It was 7.6.
All right, let me do 7.6.
And then this was going to be on a 4-year balloon amortized for 55 years.
Okay.
55. And why did you come up with that?
So basically the idea was that the term on this note that we would be selling, that's like basically this note that we'd be creating right here. When we were going to sell it, like maybe in 5 years or however many years down the line, this would be paid off before that second note that we'd have with that.
Why a 55-year term? Why would you do that?
I think we were just
Payment
down with the
down
amortization to get the numbers down. Because the monthly payment at that.
I'm ready to know if you can even do 55 months. I know you can do probably 40.
55 years. No, I've never, no, I don't.
I don't think that, you don't want to do that anyway. I mean, you can't, you want to make it work. Let's leave it at 360 and let's see what we get. Okay.
Mhm.
So let's just solve it this way. So your buyer, I don't think you can, I don't think you can try to go sell this on a 4-year arm to an owner finance buyer. I think you gotta look at it as like, let them write a 30-year term, but then I'm gonna have to sell the note when my other one is due. So arbitrage it short term, and then when your note is gonna becomes due, then you liquidate out. So let's just look at it real quick here.
Yeah.
So if we go, the first one in here, let's go 60 months, okay? So in this model, it looks like your cash flow at about $635 a month if you do a 360-month term, okay? See, 360, 3,000, and you're 435 at 5%, 2335, okay?
So the cash flow based off your cost, well, now, but one of the things you have to keep in mind is you got to figure out how to get the 40,000 back. So how long does that take? You
Well,
know,
he's getting the down payment though.
right? So you'll get your cost will get paid off with your
He's getting
down payment.
$60,000 down payment.
Yeah. Okay, so that'll
So
probably be a
So
wash.
let's just go to the illustration purposes, and then we'll figure out how much it's gonna cost you in the end. So you're gonna get about, what does that come out to be? 2335 from
About 650-ish, right?
no, it's 665, okay? So
Okay.
665 a month, and you only get 60 months to cash flow this, right? So let's go out 60 months. In 60 months, you're gonna have an event that says you gotta pay your lender, okay? In 60 months, you owe him $399,455. Call it 400,000, okay?
So, and 400 divided by 485, which is the value, the seller finance sales price, right? Which is at 82%. So that's a problem.
Well, no, we gotta see what the payoff is from we gotta look at the note on the other one. So let's look at this one. Let's see what they owe you in 60, and see what your borrower owes you in 60 months. Okay?
Oh,
And then we're gonna figure out the yield, okay, on what we would sell that note for. We're making some assumptions it's gonna perform, okay? In 60 months, you only are owed 402. Okay? 402 versus 400, that's not very much equity in there, even though you just made 600, was it 655 a month for 60 months? How much is that?
but he also had 40,000 in costs, which is 60 months. So it's basically a
Yeah, but he
total-
got that back in the down payment.
Oh, right. Sorry. Yes. The
Well,
60 grand will be washed out.
There's no cash left because you gotta pay fees, whatever.
Yeah.
So
Yeah.
in 60 months, you have an event that causes you to pay off your lender, okay? Well, based on these numbers, you're only owed 402, you owe him 400. Okay, so now the question is, you have an unpaid balance of 402 and you have a 7.5% mortgage, okay? 7.6. So here's the problem. I'm gonna tell you what this note is worth in 5 years approximately, okay?
Assuming the value is the same.
I'm gonna put this in at a yield of 10.5, okay?
So, well, real quick, how do you pronounce your name? Amika?
Mecca.
Ameka. Okay, Ameka. So Ameka, the reason he's doing this is because note investors want a 10.5% yield. That's what they want to make on their money. Okay. The reason he's doing, so now he's going to show you the value of that note in 5 years for the note investor that you need to sell this to get out of this deal if you have to get out of it. Okay.
You're at 328. So you're
It's worth three. That's what a note investor will pay for that note right now, just based off the yield. 328 minus 400. You're upside down by $72,000.
Even if you could sell it for 8%, it still goes to it's a little bit, it's pretty close to break even.
Yeah.
That's why the percentage, the interest is such a critical component, because watch what happens here. 8%, it's worth 408. Okay.
That's if you find a note investor that wants an 8% yield on a property, but keep in mind the value. If let's say it just stays at 485, the 400,
This payment right here, the payment isn't going to change, and it's all based on your original interest rate of 7.6.
So,
Okay.
but the value, so if you've been listening on the original note deal, the deal we did prior at 150,000, that was at 72%. We sold that we're gonna sell that at 88% of the 72% is what we were doing on that one. And that was at 72%. This is at 82% at par. So,
Well, the problem is you don't have a long enough term
yeah.
to get enough of a pay down. And the interest rate, there's not enough spread between what you're charging and what you're being charged.
So Nick, so how, let's just say, how do we make this work, right? What will we do on this deal?
But you got to get a more favorable rate and longer term from the seller.
Well, there's a couple things. One, 485 at 20%, you need 100,000 down, not 60. That's a starting point.
But you're not going to go into that deal. You should not go into that deal based on the assumption you're going to get $100,000 down. Now, what you could do, and that's what I was saying earlier, you can come up to the agreement with this seller and then go see if you can find a buyer that's got $100,000. It changes the whole dynamics of this.
So this is what I've done on deals like this, because you're a deal guy, man. You want to make this work, right? You've got a seller that's willing to sell you a house. Now he's technically selling you a house at market value, but that's okay. So what you do is you go, hey. So
I was gonna tell you guys really quick, not to cut you off, Eric. The actual term was 7 years, and we amortized it for 50 on that contract that we had with him. So it was 7-year balloon term amortized for 50 years. And that's what we got him under contract.
The seller.
The seller?
Yeah.
Well, let's look at that and see what that looks like.
Okay.
Still 7 years. So what was that? Still 435?
Yeah.
435, 5%.
50 years?
How many?
Yeah. So
50 times 12. That's 600 months.
I don't know if it'll go. I don't think I can go that. I think I can only go to 480. I can't go that high. I can't.
So the monthly payment to the seller ended up being like $1975.
Okay, well, that changes things a little bit.
Yeah, but yeah, so I mean, a little bit.
Personally, I would just negotiate it a little bit differently. I mean, I would just give the
7. What if I go 55 years? It's all about the payment. So yeah, it's just my amortization schedules that I have access to right this second don't go over.
I don't think that they do. I mean, you have to go to probably a financial calculator.
Hey, you know what? I mean, if that's the payment, now you're down at 1,900. But then you're trying to match it up. So what I would do is borrow at 55 and you're borrowing long and selling shorter. That's at least that's not going to work either, because you're not hammering down the amortization. You've got to at least have it.
You don't have time on your side. You don't have enough time on your side, and you don't have a big enough spread on the rate.
But here's the other thing, real quick. So here's what I would tell the seller. Listen, I specialize in selling homes to tenant buyers. So you can tell them that if you want. And because of the numbers and the terms that we have, it sounds like you're already under contract, but I need time to go find that tenant buyer. I need 45 days, so that takes a lot of risk out of your situation. This is an odd deal. It's an interesting one for sure. I just don't know how to.
The problem with you paying the price that you're paying for it.
No,
you just need better terms. You need to have a lower interest rate or an escalating interest rate, and you need to be able to create a bigger arbitrage between your buyer and your seller. Okay, that's it. I mean, you gotta, that rate's gonna have to be in the 8.5%, 9% minimum.
So you have 84 months. So let's just say it's 2,000 a month times 84 months at 0% interest. That's 168,000 off of the 425. Now that gets exciting. That could say, hey, I baked in your rate by paying you what I am. I just want to have just principal only payments for that time. That could work. That could work, right? Because if you took 2,000 a month times 84, that's 168, and you owe 120. You started at 425, right? Now you only owe 257,000 in 7 years. Now that makes sense. That makes sense, right?
Yeah. I mean, you just need to-
Then,
I
because
would
then
rather
you can go,
see
then you can
more-
go sell that, then you can go sell that first lien if you have to at a premium because the loan to value is there, right?
I would rather see you give him more money per month and get a lower interest rate. So you get that principal pay down faster. So that in 5 years, you have a bigger.
Yeah,
additional
yeah,
return.
yeah,
First one.
yeah.
So, but you know what, regardless, you have got to know the answer to the question before you ask it. And the question is, what's my buyer going to be willing to pay me for this house? And what interest rate and what payment can I get them to agree to? And what's the payment? If you can't answer that and don't know the answer to it, you're playing with fire on that, okay? That's why on these kind of deals that get to that, unless you know that you can make a 10% rate, 10.5% rate work, because there's not enough arbitrage in this deal that you can't make it work. That's why the modeling is done this way. So you don't make a bad decision, okay? So if you make that, when you go back to the modeling, if you don't see, if you're negative $20,000 and it only yields you a $30,000 second lien, the deal will stop, because you need to be at least 2.5 times your investment relative to the note.
Here's the one positive. I'll give you a couple positives, right? So the 2,000 times 84 months, right? 84 times 2,000. So we know that's 168 minus the 425, right? So that gets you at a good number. So you still create a first and second, maybe that 485, you got 60 grand down. Now, and at 70%, that's 297. So you could create a first for like 297, a second for the difference, and then write it out that way. But here's the best part.
You're gonna have a problem in 5 years when you go to exit, because your interest.
No,
rate
he's got it at 7 years. He's got it 7 years.
It's still too low. There's not enough pay down on the arbitrage.
Unless if it's at 0%, there is.
Oh, of course.
Yeah.
If
And
it's
actually,
0%,
Will
it
Westbrook
doesn't
put in
matter.
here. Will put in there 3.59, but we won't go into detail. But my point, here's my point. If you do this and you have 7 years is still a long time for that investment, for that seller. What you want to make sure is you get the first, if you do it and you want to maybe keep it as a rental, I don't know. But the point is make sure you got first right of refusal to buy his loan, because 7 years is enough time to where he's going to want to liquidate, and you know what a 0% interest loan's worth. I mean, think about it. If you're only getting 2,000 a month and times 12, and someone wants a 10.5% return, that loan's
I would
only worth
give him the same monthly
$228,000.
payment. Give him the same monthly payment,
Yeah.
but change the interest rate, okay? So
Yeah.
what'll happen is, so like right now, if I solve it.
Yeah, go to 3.6. Go to 3.6.
Hang on, let's solve for this first.
Oh,
That's 300. So right now, you're basically giving them 435 at let me put this at 360. It's a little bit off. Not much though. Doesn't really matter.
this
So
is
that's
fun
crazy.
because you get Nick and I talking, then we figure out.
So if you right now,
I'm trying to
you're
figure it
gonna
out too. I'm trying to
no, right
tap
now
in.
you're gonna give him, so you gotta figure out what the seller wants, right? Does he want cash flow? Does he want a certain dollar amount? Does he
So
want
the cash flow, so he definitely was very keen on the interest, right? That's why we were kind of like,
Well,
going
then he
back
needs to give you 20 years, you know? He's gonna have to give you a bigger bullet.
It's either price or term. So if he's going to give you, you're giving him price, you need to get flexible on the terms, because
You guys have to lower this down. So let's just solve for it here. If you give him 23.35, okay? And you wanna only pay him the equivalency of 3%, then he's gotta sell that to you. I'm sorry, wrong way. And you wanna pay him 3%. Then you can pay him, then in theory, you could pay him $553,000 for that house, okay? Because the interest rate's low and the payment doesn't change. Is that what you want to do? No, you don't need to pay him that much, right? So let's go back to 435. So if you go 435 and you're able to give him the 3%, now, and you leave the payment where it is, your term goes from 360 down to 252. Okay? Goes down to 252 on the term now. Okay? Because, I mean, that just knocked off 110 payments that are amortized just by changing that rate a little bit. So, but you maybe say, you know what, I'll give you, do me at 3%, but I'll give you $2,500 a month. Okay? And you do a 360-month term and see what this purchase price is. Purchase price now goes up to 592. Okay? You see what I'm saying? You can control this. Now, is this a good deal? Oh, hang on.
Wait, that's wrong. You got 25,000.
Yeah, that's okay. It's the same thing. It's gonna go down $100 or down a decimal. Like, so my point is, now, if you don't want to, if you want to solve for payment, then you just come in and do 435. And, you know, you can 435, hang on, 435. And you want to solve for payment at 3%, then that payment's going to drop. It's going to drop down to 1833. Okay. Or, you know, and say, hey, well, let's do this and I'll do it on a 3-year term. Give him something back in return. I think if he wants 5% and the payment's 2,300. See if this comes out to be what this comes out to be. That's about what it is. If he wants 5%, then you're gonna need to, you know, you're gonna need to lower the purchase price down, you know, 400.
Yeah, you're gonna have to get to the number that yeah.
You have to be able to create a big enough arbitrage to make the money back.
I would, his payment needs to stay the same. The price is fine. He needs to lower his interest rate and give you a little, well,
Personally,
7
I would
years,
come in-
7 years is not all that bad. That would actually get you a number where you're not, where you could actually make some money, I think, on the note sale.
You
during
can
that
be
period.
okay. You just gotta make sure you structure it right on this, but I would say on this, I would wanna see, you know, I would probably say, look, I'll give you $2,600 a month.
Mhm.
And I'll give you, you know, if you give them 5%, then that changes us to,
That's 26,000. Same thing, still 484.
it's just because it's slow on
Yeah.
that.
Yeah.
Now you can give them a higher asking price. See what's going on here?
It-
So I would rather see you give him I would come in and say, I would rather give you $500,000 for the house, Mr. Seller. Okay? Give me a 3% interest rate. Okay? And a 10-year balloon.
But Nick, you could also do, hey, I'll give you 2,300 for the first 36 months. And then and then after month 36.
Oh, you can still do $500,000 at 3%, and still pay him $2,300. And now your term goes all the way down to 315. You just knocked off 4 years almost. Okay. So I personally like to overpay to the seller their asking price. No, this is not.
But why you do that is because you get a longer term, and that longer term gives you time.
Because now let's look at, okay, now let's look at 10 years, okay? Let's just say I'm gonna go back to 360. Go back to the payment, okay? We know the other one's we're gonna be able to cash flow not, we're gonna show that number, because now we can actually sell it for less if we had to than what we paid for, because the amortization is gonna catch up. So let's look now, let's go 10 years now. So in 10 years now, I'm gonna owe my seller, even at $500,000, and that's a lot of money. We probably wouldn't go that high. Don't need to go that, but I'm just using it for illustration purposes. I'm gonna go out 120 months. Now I only owe him $380,000. Okay, remember before I owed him 400,000, but I got 10 years out of it now. So now let's go back to the other amortization.
Loan to value is still too high, but
Whatever, but let's just say that we sold it, let's say we sell it at 450. I'm just using numbers
he
because
did 485 was the sale price.
but there's cash down. But let's say we're able to get the 9.5 that we need. Okay. That payment's gonna go up to, Okay, let's go.
I think that
Let's
you'll
go- I think we
be,
go to 8.
I
Let's
think
go to 8.
people can pay more for that property on terms than you think. That's my other
I
opinion.
agree. So now at 8% on 450, let's just follow the math. Okay, so what this says, we're selling it for less than we bought it for. Okay, I'm just shooting illustration purposes. We're getting $3,300 a month on less of a purchase price than we're paying, and we're paying $2,100 on $500,000 because of the interest rate. So we're making $1,200 a month cash flow on a difference of $50,000. Now let's go out and see what our buyer owes us in 12 years or 10 years, 110 months. Let's see if this is what happens when you can overpay. So now they still owe you $395. So you have a $15,000 equity position.
And 1,200 a month cash flow,
So what's 1,200 a month times 120 months?
144,000.
$144,000. Okay. I made $144,000. So now let's go back up to here. And this is just round math. Let's just say I want to sell this now, and I need to sell it in a 9. Let's say I gotta sell it at 10%. This isn't gonna be exact because there's 10 years of payout, but it'll be close enough. 450, 370. I can sell that note for basically about 300 and what was the unpaid balance?
It's 380. It's almost a wash. It's $4,000 off. Yes.
It's off a little bit, but the payoff was how much was the payoff before? Hang on. Let me go back.
380.
No, it was more than that, I thought, on 120 month. 120, 342. I think I changed this up here. I have to go back and put that. 8 months. Oh, it's
I think we had another question. I don't know.
Right,
This
hang on
one's
one second.
longer.
Let me solve this again. 450 is that. So what I'm trying to do is figure out what the note value is. So in 120 months, our borrower still owes us, was it 402? Owes us 390, call it 395. All right, 395 is the number. So if I want to sell this for 395 at that payment, that rate is going to go to 9.45. We're pretty damn close. Okay.
Yeah.
So if we could sell that note with 10 years of performance, that service and everything, which would be really good, and we could sell it at a 9.5 yield, we basically are out of the deal. The notes are gone, and we just made $145,000 at $1,200 a month.
You created a $1,200 a month cash flow on this deal. That's what that is if you structure it correctly. So that's where I am at. But this was a good. The higher value properties is where it gets a little like that. We stick to the median home prices, but I mean that's probably median home price in that market.
But you can still do it, but what I'm telling you is that you have to find, my opinion, if you're going to go against the norm, okay, then you have to go find that buyer first.
Yeah. You don't want to take the risk and do it. And if you have time,
tell the seller, go, look, I need to go find I'm going to find a buyer that I'm going to finance, or a tenant or whatever you want to tell them. But you need to find them first because you need to make sure it's going to cash flow. And
you're not
the buyer.
That was one of our biggest things. That's why we got so much time on the contract to be able to have that time to vet out this wrap buy that we're going to be selling.
How much time do you have to close on this?
Like another month.
That's enough time.
You're gonna know pretty quick. Is it vacant?
Yeah, it's vacant. It's vacant. It's still staged how it looks like in those pictures.
That's great.
Yeah.
Then just start marking the hell out of it.
Yeah.
Right to do it and see what your buyer is willing to pay.
Because worst case is once you get your buyer in place, then you just back into what you want to
Yes.
re-trade him at and the cash flow you want to make. That's what I would be
All
doing.
you can do. That's all you can do. That's what you would have to do. That's what I would do. And I
Yep.
would find my buyer, and if he comes in and if you can come with them, because you might get $100,000 down payment, man.
Right.
Not unrealistic.
Yeah.
A lot of buyers, man. So
You
I
guys
would
typically
say-
have like an arm or low that you like have to use for your.
again, remember we talked about this. So find the deal, analyze the deal, fund the deal, find the buyer, send it to the transaction coordinator. That's their job. They'll get all that done for you. If you're gonna sell this note in any time in the future, you're doing yourself a disservice if you're not using a transaction coordinator. Because they're gonna write the note the correct way, they're gonna make sure it's serviced correctly, they're gonna make sure the right verbiage is in the promissory notes from a lender perspective, not a legal perspective. Because what happens a lot of times, that attorneys write their mortgages and their the promissory notes, the warranty deeds, deed of trust, they write them from a legal perspective, right? Not with the lender in mind. Well, you want both, right? Because you want to be able to protect your investment. You want to have different things in there. So we want to really utilize the verbiage the correct way as a note, from a note buyer's perspective, so you can get max value on it. That's the whole key. And when you don't do that and you don't follow the protocol, it's going to cost you probably somewhere between 8 and 10% of the loan value because of the discount you're going to have to give up.
But Nick, just so everyone's clear is once you know the numbers, that's how you know how much to create the first and second for. That's the most important part.
Yeah, we'll help with all that too.
You
So
still want to create a first and second, even though you have a
100%.
a seller
You're
finance buyer.
just gonna manage them, because you might get to the end of 10 years and go, all right, well, let's just see, maybe I'm willing to keep that performing second note and invest $10,000 and get the 50,000 back in on it.
Yeah,
Why
yeah,
not?
and the seller might want to liquidate that note, and you want to make sure you have the sooner even at 5%, it's a smoking deal if you structure it right. But I want to get to Cheryl here because
Michael, that's good. Thanks. Hope that helps you out. And then we'll go for
if you have any more questions, just put it in the Facebook group, and we'll get to them as quick as we can.
All right. So let's go through these next couple. We're not gonna do any more models, but we can answer some general questions, and then if we can go next week. So
All
let's
right,
go to
Cheryl, you're next.
Hey, Cheryl.
Hi. This is pretty simple. I just got a simple question. This would be my first time wanting to sell a note. So I have a seller in New Orleans, and his house he wanted seller finance it for $275, but he wants such a high down payment. He want $100,000 down, 5%, but it's a 30-year. He said he'll take 30 years. So I'm wondering, should I negotiate him down maybe
Yeah.
maybe
Too big of a
to
down payment.
3? He want the down payment. Like if I don't negotiate the down
Well, then you
payment,
know what? And then you might not just be the buyer for him. All right. I want $1
Okay.
million, but I'm not gonna get that today either, right? So
Yeah.
we gotta be realistic in where we are in the market. Now, there again, can you get $100,000 down from a buyer? If you market to it, maybe you can, maybe you can't. But I wouldn't go into any of the commitment on, that's a big down payment. That's a big down payment.
I would, Cheryl. So I'll give you my personal opinion. When sellers want that kind of down payment, there's a bunch of different exit strategies. But the first thing I would do is say, listen, I'm going to sell this on it. I work with with tenant buyers, right? So let's contract at that price, and then give me 45 days to go find my tenant buyer. And then it may or may not work. And if it doesn't, then, let's say you get 50,000 down, and you can sell it at 10% interest, and he's at 5% interest, and you give him the down payment, and now you just arbitrage that. Now you have a great deal. Now you have a really good deal.
I think the way to look at it, to what Eric's saying, you got to work it backwards. All right.
Yeah.
You got to think of it. Can I realistically get this house sold for? Okay. How much can I realistically get down for this house?
What's the value of the property?
it's saying on Zillow it says 309,
Okay.
and yeah, it's a 4.3.
Okay.
The house, it needs renovation, but it's in pretty good condition. Probably maybe a basic renovation, nothing really harsh to it. So yeah,
I would do no renovation. I'd contract it and go find my tenant buyer. I call him tenant buyer, but seller finance buyer, and see what the market bears for down payment. And then go back and renegotiate and say, this is what I'm willing to do. Do you want to do it or not? And if they say no,
You guys gotta realize you guys have the hammer right now.
yeah,
The sellers no longer have the hammer. Okay, really important. What a seller wants and what they get are two different things now.
yeah.
3 months ago, the seller could call the shots, they had the hammer.
But
If you
like,
want-
just real quick, just back to what we were saying. Go, if the seller will allow you to have a longer closing and you, so you can go market to the buyer, then do it. If not, then I don't know. I wouldn't go too creative on the down payment side and even if they're willing to subordinate, that's another option. But I wouldn't do that until I find
You think about down payment. Think about this, it's way too much money because if you're putting $100,000 on the one property, man, what if you could, I mean, if you could do $20,000, you could do 5 properties, right?
Yeah.
So
Yeah.
the leverage and the return is just not there. It's just not enough, there's just not enough in that deal, in my opinion, at those numbers, but it doesn't mean they won't take another option, right? You make it.
yeah.
Give them more money, give them a higher sale price, get better terms. I mean, do
yeah,
it.
what's more important, price, terms, or down payment, and then you back into it.
And we'll back into and solve it at 100%. A lot of times they want to think they're getting the better end of the stick, so they say price. I love it when they want price. When they want price, then I can work the terms to my benefit, and I can overpay. I can pay 150% of what they're asking for.
Hey, I have a question. Does your background add more hair? Why do I not have as much hair as you do in this deal?
I don't know, we need a haircut.
Hey, so Cheryl, yeah, that's kind of where we would go on that. And then because we're going long tonight, I want to get Carl on.
Want to get Carl and we'll wrap up. And I'm not saying that's not a deal.
Quick question,
Yeah,
quick
sure.
question.
Sure.
Because if I can negotiate down, because I was actually going to try to see if you guys can help me, like JV, and find the buyer. So if I can negotiate it down, would I be able to submit it to you if I come with different numbers, like structure it different?
Well, we're gonna be more
mark?
focused on the note side. You mean as far as making sure the deal works? I think there's probably
No,
some-
the note side.
Yeah.
Yeah, that's what we do. So we want to make sure the note gets written correctly. We want to make sure it fits that criteria of that 70, the 72% and 88%.
And what market's this in again?
It's in New Orleans.
Yeah, that's right. Okay.
Like one of the better, it's like I guess the upper side is the better area of New Orleans.
Okay.
Like Carrollton
I
area.
think there's some really good people, and I don't know if they're on the call, but they're definitely in the group that can help you restructure that deal with the seller, right? And help
So
you.
go on
figure out what
Facebook.
that-
Yeah, just definitely put your information, the deal you're working on, in Facebook, and then we'll, between us and the group, we'll be able to try to give you some ideas. But here's the thing, if you can contract it and go find them, and they give you time to go find that buyer, then you have no risk, and then if it
So
doesn't
here's
work,
what you gotta find out. Why does the seller need $100,000?
yeah.
He said,
You need to know
yeah,
that.
he told me. Yeah, he
What
told me
he's
why.
saying.
Why does he want it?
He's trying to purchase another property.
Okay,
Take the money and purchase another property,
okay.
pretty much.
Well, I mean, if that's what his number is, then you're gonna have a difficult time, I think, structuring. this.
That's not true, because she could go get financing or
Well,
at
you gotta-
$100,000 and subordinate.
I'm talking about at the rate and the term that she has now.
Yeah,
Okay.
You could probably do $100,000 and do a 0% interest and a 30-year term and a lower payment. And then you could go borrow the $100,000 at 10%. Now you got $100,000 at 10%, then you got roughly $200,000 at 0%. The effective rate on that is, 3%. But he's gonna have to, if he wants $100,000 down, you're gonna have to get something back in return. And it's probably gonna need to be term in low or no interest. There's no other way it's gonna work. No
Right.
other way, I think.
Yeah,
is-
you're baking in his interest in the price that you pay. So that's kind of how
Can't
I,
get everything. You gotta get something back, all right?
yeah.
Okay, okay. I'll put
right.
it in the Facebook group. Thanks,
Yeah,
guys.
do that.
Yeah,
All right,
great.
do that.
Great
All right,
show.
last question tonight. Carl, what's up, Carl?
Hey guys, how's it going?
Good.
What's up?
Good. Thanks for taking my call. My first time in the group, been following you guys on Facebook and everything with the creative deal maker and everything. So I'm
Awesome.
interested
Welcome.
in doing this on the project. My question is about a property I'm actually getting ready to buy sub to.
Awesome.
She actually has 2 loans on the property at this time. Wondering if this is something where I could create one of these notes that you guys are talking about. On her
What's the
first
total
note,
debt? What's the total debt that you have on the 2 loans? Did she do a loan mod? Is it like a partial claim or something?
so during Harvey, she had some, and the insurance hadn't paid off quick enough, so she got an SBA loan. So the SBA loan is for like 1.5%. That's on 76,000. But her
She
underlying
making a
loan,
payment on that too?
the payment on that is.
Is she making a payment or is it deferred on that? Do you know?
Oh, she's making payments on it.
All right, so she's got a 1.5 USDA or a SBA loan at 76,000. And how much is it an FHA loan or something?
So no, she did a equity loan on the property. It's for 90,112, and her rate was 9.25%.
How much? 9.25?
9.25.
So basically, it's $170,000 is what's owed on the property.
Yes.
And it's at about a 5%, a 5% blended average.
Yeah.
She owes 9 and 1.
What's her total payments between the 2 loans? Do you know?
Total payments between the 2 loans,
Really just
is-
high.
I believe it's like 1,500.
No, that can't be right. At 10%, that's you're including principal and interest on tax and insurance on that. It's got to be lower than that. What's the principal and interest payments?
So 289. Oh, okay, gotcha. So let's see, on the SBA loan, principal and interest is 289. And on her equity loan, let's see, the principal and interest is 790.
Yeah, that's what I figured. Okay, good.
So
So yeah,
how much is the
1,100.
property worth?
Yep.
Sir,
How much is the property worth?
250,
Okay.
actually about 260 according to Zillow.
And where is it? Is it, you said Harvey, so is this down in Houston?
Yes,
Okay. So was it in a flood? Is it in, did you run the flood, the flood risk rating on this one? Did it flood?
so she took in a couple inches of water in the back. She's not in a flood zone, she's in a flood way, which she's on. There's a bayou behind the house. And so as a result of the what we had during Harvey, yeah, she took in a little water.
So the challenge is we need to know what we can insure it for, right?
Yeah. Insurance.
We just did one and the insurance was like three times what it would be in another part.
And
of the
then,
state.
and the reason you asked that, and in the model, it asks you, but now all of a sudden it becomes the affordability factor. But I just did round math. If you sold that at 260, you got 26,000 down, 10% interest, that's 2,000 and change, 2,100, and you have 1,200. So that's an $800 a month cash flow deal. Now you do
still
have,
first and second and wipe out. And you could wipe out, what I would do is wipe out the 9.5% immediately.
well, I would, yeah,
There's no reason to
because
keep
it's
it.
variable.
Why
Yeah.
would you keep it? There's no
Yeah.
reason to keep it. Pay it off, right? You're not getting any, you can't arbitrage
And then then you're gonna arbitrage off the 1.5 at a 10% interest. It's a home run.
You could do that for sure, like right.
Yeah. And you'll get a better, the first lien, you'll get a premium because it's gonna be at like 50%. No, shoot,
Yeah.
it'll be less than 50% loan to value.
You can look at it and see,
Yeah.
is it vacant or occupied?
Vacant. She just moved out.
Okay.
Okay,
So
so you have the deal, you have, it's vacant. And what are you gonna pay for it? What she owes on it? That's it?
Yes, pay what she owes on it. I'm giving her 15 grand.
15, okay, so about
Mhm.
185 is what you're paying for it, right?
Yeah, yes.
Plus closing costs.
Definitely looks like a deal on paper, because we can write it first, we can do let's just see what how much, so what is the total debt on it? Let's figure out that first.
170,
170, including the 15?
no, plus the 15 is 185
So
approximately.
you take 185, divide that by 0.72,
256, it's right there.
but you gotta pay a discount on that too, so you gotta probably, no, hang on a second, if you write it to 185, no, just hang on a second, 185 divided by 0.90. Let's see, 185 divided by 0.9, 205, so you gotta you gotta write a $205,000 first lien to get 90% of it, which would give you 185, okay? So the first lien has to be 205, okay? So that way you could take the 205 and
You'd
sell
have
it.
a $35,000 second lien.
Yeah,
But here's the problem, Nick, though. You don't want to do that because you want to keep that 1 point.
well, I get it, but you still gotta model it that way.
Yeah. Oh, right. You can model it that way,
You
but
gotta model it that way, because you still gotta wipe out.
But he can lower the first lien because he can lower you want to keep the 1.5% interest rate.
Right, so if that's the case, you gotta take the 15, and how much is the first lien? The
First
lien?
90,000.
So all he's got to do is create a $90,000 first lien and get rid of that. That's it.
Divided that by 0.90. You gotta write it for about $120,000 first lien. Okay,
And then you would have a 200. So you'd have $100,000 you'd have $100 and something
it's a
thousand
little
dollars.
bit of a tricky situation though, because then you're left with a really big second lien and you have debt still at the 1.5%.
Yeah.
So it's probably still worth doing it, but it doesn't matter, because here's the deal. You could still do this deal and just arbitrage it for a short period of time if you wanted that spread. Or you just wipe the whole damn thing out, doesn't matter.
I would
like
want
1% money, and I do too. But at the same time, if you can create a free and clear second lien for $35,000, that's not a bad gig either.
here's what I would do is obviously get the buyer, contract it, go find the buyer, and then get with us and we'll help you. That's where we would come in and help structure that first lien.
I think personally that for somebody with a little experience, I would probably take the money and run.
How do you know Carl hasn't done 20,000 transactions? How do you know?
Yeah. No.
If he's done that many, we would not.
Maybe one day I'll catch up to
If
you
he
guys.
hasn't that many, he probably wouldn't be listening to us. We would be
What
listening
do you
to
mean?
Carl.
There's not. Why we get all the gurus all over the country listen to us? They call us personally and ask us how to do the same stuff.
I think, but what we want to try to show is how do you get to no risk and cash flow. And, you start dealing all these other tangents, you run the risk of not being able to solve it. I don't know, I have to think about it. I don't know how you solve that. I don't know how you solve that in the event that SBA loan
Gets
comes
called
due.
in, yeah.
Because because you're holding a second lien.
Now, is the SBA loan leaning the property? Is it on the property?
Yes.
It is. Okay.
Yeah, it was on the Schedule C.
So let's just say you have $100,000 second lien. Okay, well, it's gotta be more than that. What is 116?
No, it's 111. I figured it was 111. That's what I figured.
Second lien that we write?
Yeah, because he's gonna
So
sell
you're-
for
so you're
260
telling
with
me you're gonna
10%
write
down.
To write $115,000 second lien, and have that SBA there, I think you're taking too much risk, because the market value on that second lien is probably 50 cents on the dollar.
But hold on, Nick. So what's the monthly payment on that?
You're not listening to me, man. I get you guys are getting drunk on cash flow. You can't do that. You have a situation here. If you have a second lien and you're in a second lien, because the first lien is the first lien, and you wrote it a small amount, and the second lien is there, okay? That's junior lien to the first. The value on that second lien is probably 50 cents on the dollar.
Okay,
You have to assume it's 50 cents on the dollar,
Hmm.
okay?
yeah,
Maybe you get 60, okay? But we want to model conservative. So if it's 50 cents on the dollar and there's any issue that comes up, anything whatsoever, okay? You got a 50% second lien cash out value at about what, $55,000?
and what's the second lien again? How much is?
$76,000. I would never put myself in that position.
Yeah, that's right, yeah,
That's me. That's me though. What I would consider doing is writing a first and a second lien, arbitraging the two, and then selling the bigger first lien to wipe out both the underlying debt.
Yeah.
If I had to do it, I
Yeah.
would do that.
yeah, that's that, and then you run it until you can't run anymore, and then sell
That's
it
what I
off.
would do.
That's a
Or
great
in a
idea.
lien trust situation,
Yep,
I just sell it all and just say, hey, you know what? I'm gonna take a double on this one.
yeah, but you're
You
still,
know,
but your
bro.
cash flow during that period, your cash flow is great. You're getting a
Even if you
$26
wipe out the
target.
debt, even if you pay everything off, you're still left with a
Yep.
$35,000 free and clear second lien.
Yes,
You can't take that away from you. It's there. So
yeah.
that's what I mean. Those are a couple of your options there, Carl. Hope that helps.
Okay.
I think
If
you
you have any
does,
more
I
questions, please put it in the group, in the Facebook group, everyone.
we got a lot of people that can help you with getting the structure done in Houston.
And then always get back on these calls, man. These are great. So,
Yeah, great
yeah.
information. I really appreciate your help.
yeah,
Yeah.
great. I like that deal.
All right. I think it's
Hey, you
definitely.
guys, if you guys have any more questions, please put it in the group. We appreciate you guys being
Okay.
on here for almost 2 hours. I know it's getting late on the East Coast. I'm on the West Coast. So,
I'm in my
we'll
pajamas
see.
right now. You just can't tell.
Yeah, I know.
I got my
So
bunnies.
we'll see you guys next week, and you guys have an awesome week.
All right.
Thanks for being on the call.
Take care. See you now.
All right.
Thanks, guys.
See you guys.